What you are about to hear is not a prediction. It is not speculation. It is not someone's opinion. It is a convergence of hard data, institutional research, and geopolitical reality colliding at the same moment in history. And if you are not paying attention right now, you are going to look back on this moment with absolute regret. We are living through a monetary transformation that happens once every few generations, and the people who understand what is unfolding in gold and silver right now are quietly positioning themselves on the right side of the most consequential wealth transfer of the 21st century. Let's start with the facts on the table, because the numbers don't lie, even when governments and mainstream financial media refuse to talk about them in plain language. Gold surged 65% in 2025. That is not a typo. 65% in a single calendar year, the second best performance since 1970. Only 1979 eclipsed it. And if you know your monetary history, you know exactly what 1979 smells like. It smells like a system under extreme stress. It smells like the beginning of something that doesn't end quickly. Gold punched through $4,000 per ounce for the first time in human history. It then blew past $4,300. And right now, as you are watching this in February 2026, gold has climbed back above $5,000 per ounce. The same analysts who told you $3,000 was impossible are now quietly revising their forecasts not to $5,000, but to $6,000, $7,000 and beyond. JP Morgan, one of the most influential financial institutions on the planet, has set a Q4 2026 target of $5,000 per ounce, with $6,000 a distinct possibility over the longer term. TD Securities' head of commodity strategy said his team still likes gold fundamentally, with a quarterly average target of $5,000 and a technical ceiling closer to $5,700. Goldman Sachs, Deutsche Bank, Citigroup, they are all singing from the same sheet of music now, and that sheet of music is bullish. A Reuters poll of 30 analysts and traders now puts the median 2026 gold price consensus at $4,746 per ounce, the highest annual consensus in Reuters polling history going back to 2012. When Wall Street agrees this unanimously, something structural is happening that cannot be ignored. But here is what they are not telling you loudly enough. The reason gold is doing this is not simply because people are scared. Fear is a catalyst, not the engine. The engine is something far more permanent, and it has been building for decades. The U.S. squared national debt now stands at $38.5 trillion and counting. The Federal Reserve has been trapped in what monetary economists call fiscal dominance, a condition where the size of the debt itself begins to dictate monetary policy rather than economic conditions. You cannot raise rates aggressively when the interest payments on $38.5 trillion in debt threaten to consume the entire federal budget. You cannot reduce your balance sheet without destabilizing the treasury market. You are locked in, and the world knows it. The U.S. dollar index fell nearly 10% in 2025 alone. Morgan Stanley believes it could fall another 11% in the next 12 months. The dollar's share of global foreign exchange reserves has slipped to a two-decade low. Foreign ownership of U.S. treasuries, once above 50% of the market, has now fallen to just 30%. The world is quietly, systematically, and deliberately walking away from the dollar. Not in a straight line, not overnight, but in a direction that is impossible to reverse without fundamental fiscal reform that shows no signs of coming. This is the backdrop. Now let's talk about who is buying gold and why, because this is where the story gets extraordinary. Central banks purchased more than 1,000 tons of gold every single year from 2022 through 2024. 3 consecutive years of institutional accumulation at a pace more than double the 2015 through 2019 average. In 2025, central banks added another 863 tons to their reserves. ETF demand surged 801 tons, the second largest annual inflow on record. Quarterly investor and central bank demand averaged around 950 tons, translating to approximately $109 billion of inflow in a single quarter. The World Gold Council's 2025 survey found that 95% of central bank respondents expected global central bank gold reserves to increase over the next 12 months. 73% of central bankers believe the U.S. dollar's share of global reserves will decrease over the next 5 years. These are the people who manage the monetary reserves of sovereign nations. These are not retail speculators. These are not newsletter writers. These are the institutions that built the current financial architecture, and they are hedging against it. Here is why that is so significant. In 2025, gold overtook the euro as the world's second most widely held reserve asset. Let that sink in. Gold, the metal they told you was a barbarous relic, the asset that yields nothing, the thing they mocked you for owning, has now displaced the second most important fiat currency in the world from the reserve portfolios of central banks globally. And in the international banking system, gold has been formally recognized as a Tier 1 asset. That is a complete reversal of the monetary framework that has governed the world since 1971, when Nixon closed the gold window and severed the dollar's link to gold. We are watching in real time the remonetization of gold at the institutional and sovereign level, and that process, once begun, does not reverse easily or quickly. Now let's talk about the geopolitical dimension, because this is the accelerant being poured on the fire. The BRICS bloc, which now includes Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, the United Arab Emirates, and Indonesia, represents approximately 48.5% of the world's population and 39% of global GDP measured by purchasing power parity. On October 31st, 2025, these nations launched a pilot of what they are calling the Unit, a basket-backed, collateral-anchored settlement instrument designed for wholesale trade that does not require the U.S. dollar. On December 8, 2025, a full prototype was launched. The unit is structured with 40% gold backing and a 60% BRICS currency basket that adjusts daily. In October 2025, the BRICS bloc also announced a new precious metals exchange where members can trade physical gold and other metals directly without using U.S. dollars. The combined gold reserves of BRICS member states now exceed 6,000 tons. Russia holds 2,336 tons. China possesses 2,298 tons. India has 880 tons, and Brazil made its first gold purchase since 2021 in September 2025, adding 16 tons to bring its total to 145 tons. BRICS nations together now control approximately 50% of global gold production through a combination of member state output and strategic partners. This is not economic nationalism. This is a coordinated, deliberate, multi-year strategy to build a monetary architecture that is independent of Western systems, and gold is the foundation upon which that architecture is being constructed. Meanwhile, China's CIPS cross-border payment system, designed to operate independently of SWIFT, now has 1,467 indirect participants across 119 countries, linking 4,800 banks in 185 nations. The infrastructure for a parallel global financial system is not a theory. It exists, it is growing, and it is eating market share from dollar-based systems every single quarter. The process of de-dollarization is described best by economist Robert Triffin's paradox. For a national currency to serve as the world's reserve, the issuing country must run perpetual deficits to supply the world with liquidity. But those very deficits eventually erode confidence in the currency. The U.S. has been running this playbook since Bretton Woods, and the world is now reaching the end game of the Triffin dilemma. The world is shifting from what monetary theorists call inside money, promises, debts, obligations to outside money, which is a hard asset that carries no counterparty risk. Gold is the ultimate outside money. It has no issuer, it has no counterparty, it cannot be defaulted on, it cannot be printed, and right now, every major force in the global economy is pointing people toward it. Now let us shift to silver, because if you think the gold story is extraordinary, what is happening in silver is even more explosive and far less understood by the general public. Silver did not just move in 2025. Silver went parabolic. The metal rose 147% over the course of 2025, more than double gold's already historic performance. Silver hit an all-time high of $121.64 per ounce on January 29, 2026, before a sharp correction brought it back to the high 80. JP Morgan sees silver averaging $81 per ounce in 2026. BNP Paribas has suggested silver could reach $100 per ounce by the end of 2026. Bank of America raised its 12-month silver target to $65 per ounce just in mid-2025, and prices have already blown past that. The Reuters consensus for average 2026 silver now sits at $79.50 per ounce, revised sharply upward from just $50 in October 2025. Silver is moving so fast that institutional forecasters cannot keep up. Here is why silver's story is fundamentally different from gold, and why it may be the most undervalued strategic asset on the planet right now. Silver is not just a monetary metal. It is an industrial metal with irreplaceable properties. Silver possesses the highest electrical and thermal conductivity of any element on the periodic table. It is irreplaceable in solar panels, in electric vehicles, in AI server switches, in multi-layer ceramic capacitors, in 5G infrastructure, and in the electronics that power the modern world. Solar panels alone consumed approximately 230 million ounces of silver annually in 2025. Global photovoltaic installations are hitting record highs every year. Electric vehicle production is scaling at 20% annual growth rates in silver demand. Nuclear reactors, each one requiring approximately 56,000 ounces of silver, are being built at an accelerating pace to power AI data centers that consume electricity on a scale that staggers the imagination. Silver's demand reached 1.17 billion ounces in 2024, outpacing mine supply by hundreds of millions of ounces. And here is the critical structural fact that separates silver from almost every other commodity. Approximately 70 to 80% of all silver mined comes out of the ground as a byproduct of mining other metals, copper, lead, zinc. That means when silver prices rise, new silver supply cannot simply be called forth. You cannot build a silver mine to meet silver demand when the silver is attached to a base metal deposit whose economics are governed by entirely different factors. Supply is structurally inelastic. It cannot respond to price signals the way other commodities can. The result has been 5 consecutive years of structural supply deficits. 5 years running, the cumulative shortfall since 2021 now totals nearly 820 million ounces of silver metal that was consumed and is gone. In 2022 alone, the deficit reached 172 million ounces, the largest on record. The Silver Institute projects the 2025 deficit at approximately 117 million ounces, and that gap is expected to persist and widen through 2026. Total above-ground silver stocks in the vaults are declining. Lease rates for physical silver rose to record levels in 2025, indicating genuine delivery stress in the market. Real physical tightness, not paper prices, not trading dynamics, but actual metal that people cannot get their hands on. The U.S. government has classified silver as a critical mineral. That is not a symbolic designation. It means the government recognizes that the supply of this metal is a national security concern. And when governments start caring about strategic mineral supply, prices follow. Here is what ties this entire story together and what every person watching this needs to understand in their bones. We are living through a monetary reset, not a recession, not a correction, a reset. The last time the monetary system underwent this kind of structural transformation was 1971, when the dollar was severed from gold. Before that, it was 1944, when Bretton Woods established dollar supremacy in the first place. These transitions happen on multi-generational timescales, which is why most people alive today have never experienced one and have no framework for understanding what they are seeing. But the data is speaking. Central banks are screaming through their purchasing behavior. The BRICS bloc is constructing infrastructure. The dollar is losing its reserve share. U.S. debt is compounding toward levels that no fiat currency in history has ever survived in full. And gold and silver, the two metals that have served as money for 5,000 years across every civilization on Earth, are responding. Gold has broken through $5,000. JP Morgan's bull case analysis, built on current central bank and ETF demand trajectories, shows $6,350 per ounce by Q4 2026 and $8,650 per ounce by Q4 2027. The World Gold Council outlines 4 scenarios for gold going forward. In 3 of those 4 scenarios, gold rises or holds steady. Only in one, a scenario where the Trump administration successfully eliminates geopolitical risk, dramatically boosts GDP growth, and triggers Federal Reserve rate hikes, does gold decline. Ask yourself honestly, does that scenario describe the world you are observing right now? Silver futures have surged above $85 at the start of 2026 amid export restrictions from China, tightening industrial demand, and renewed safe haven positioning. Prot Asset Management describes the gains of the last 2 years as unprecedented, noting that gold is not designed to rise 25% and 50% per year in normal conditions, and when it does, something fundamental has shifted. The question is not whether you believe in gold and silver. The question is whether you understand what the world's most powerful financial institutions, sovereign governments, and reserve managers are telling you through their actions. They are buying, they are accumulating, they are building infrastructure to settle trade in metal rather than paper, and they are doing it at a pace and scale that has no precedent in the modern era. What you do with this information is your decision, but let no one say they were not warned. The data is real. The trend is structural. The time is now.